Becoming a millionaire might seem out of reach for a lot of us, but what if there was a way that you can actually achieve it? Today we're diving into the world of ETFs and why they're one of the best ways for the average person to build wealth with minimal time, experience, and knowledge. So what exactly is an ETF and why are they so powerful? ETF stands for Exchange Traded Fund, and it's a type of investment fund that holds a group of stocks, bonds, or other assets together, and it's traded on the stock market just like a regular stock. One of the most popular ETFs is the S&P 500 ETF with the ticker symbol SPY. By the way, a ticker symbol, if you don't know, is usually 2 to 4 letters representing a company on the actual stock market, and it's what you type in the search bar when you actually want to buy or sell a stock. For example, Apple's ticker symbol is AAPL, Amazon's is AMZN, and Nike is NKE. By investing in the SPY ETF, you're essentially buying the top 500 companies in America that are all bundled together. Companies like Apple, Amazon, or Microsoft. These are companies that have proven to us time and time again that they can make a lot of money and produce a lot of money for their shareholders as well. They're also really large companies typically in terms of how much money they're worth, and this helps them be a little bit more stable and recession proof, unlike a small company or a startup that just has a few million bucks. And the beauty of buying an ETF like SPY or even VOO is its simplicity and its low cost. Now, what I mean by low cost is that if you compare it to something like a mutual fund, which also buys a bunch of companies at the same time, mutual funds have a lot higher fees, right? Something like 1% or more, and that can cost you hundreds of thousands of dollars over the course of your lifetime, which I'll show an example of that in a bit. But I like ETFs because they're a lot lower cost. They take less money from you over time. Now, as far as getting money out of your actual investments, there's only really one thing that you need to focus on, which is compounding. Now, compounding is when the gains that you make on your money start making gains of their own. And it's like a snowball rolling downhill, gradually getting bigger and bigger and picking up more and more snow. For example, if you invested $10,000 initially and added $325 every single month at around a 10% rate for 30 years, you'd have right around $1 million. But keep going, and in just another decade, you'd be closer to $3 million. So in just 10 extra years, you almost triple your return. And that's why compounding is so powerful. It has a massive impact on the back end of your investing. And in plain English, the steeper this green line gets, means that you're making money a lot faster. This is something Gautam Baid talks about in his book, The Joys of Compounding, where he says the back half of your investing journey is where all the incredible gains happen. And that's because compounding grows exponentially, not linearly. So it speeds up the longer that you do it. Now let's take our example previously where we invest 10 grand, add $325 per month at around a 10% rate. It'll take you 23 years to hit around $500,000 and then just an additional 7 years to double that to $1 million. So 23 years of work gets duplicated or doubled in an additional 7 years. It basically takes 1/3 of the time to double your investment. Now, I cannot stress this point enough. You have to be in this game for the long term. You have to be willing to wait during those initial slow years and where it feels like it's not really doing anything. But then once you get to the back half or even the back 1/3, that's when it really starts to pick up. And consider this too, Warren Buffett, who's considered the greatest investor of all time, he made most of his wealth after the age of 50. Around the age of 52, he had something like 326 million, which we would all love to have. But then he didn't just stop there. He kept going, he kept investing. And now when he's in his 90s, he has something more like $113 billion, which is a 300 times return on his money since he was 52. So Buffett has always played the long game, and that's what he's focused on. And it's why he's been able to build this empire that we call Berkshire Hathaway. And he's been able to cement his place in the investing Hall of Fame pretty much forever. Imagine how suppressed his impact on the world would have been had he been scared off during market corrections in the early 60s, the early 70s, 1980, 1987, the late 90s, early 2000s, 2008, 2014, 2020, 2022. There's always a reason to sell. There's always a war, there's always supply chain issues, technology disruption, inflation growing too fast, GDP slowing down, a pandemic that hits, political issues. The list goes on. And yet the US stock market has never had a 20-year rolling period of negative returns. Now think about that. If you go any less than that, there's a chance that you might get some negative returns and lose a little bit of money. But if you expand your time horizon out long enough, compounding is going to show its magic. Let's talk about why this method of using ETFs is well suited for most people. First off, ETFs are very, very affordable. What I mean by that is ETFs like SPY or VOO have really low expense ratios or fees of 0.09% or 0.03% respectively, meaning you're only paying a tiny fraction of your investment gains in fees over time every single year. If you compare that to something like 1%, which doesn't sound like a lot at first, it's going to be a massive difference over the course of your lifetime, and I'm going to show you an example right now. So let's compare two accounts that start with $10,000 each. They add $500 per month and they earn an 8% return for 30 years. One fund is a low-cost ETF of 0.04%, while the other is a managed fund with a 1% fee. So the 0.4% fee, the ETF, the low-cost option, over the course of 30 years, we make about $827,000, and we only pay around $6,700 in fees. $6,700 over the course of 30 years comes out to less than $1 a day. And if you compare that to how much money you made, you're making about $75 a day. But if we take a look at the 1% fee, that costs almost $150,000 more over the course of 30 years, which is like $14 a day. So it's more than 14x as expensive. Now that's a lot of money to throw away in fees when you don't really need to. You can just use ETFs with low expense ratios and you will save yourself hundreds of thousands of dollars over the course of your lifetime. This is why it's so crucial to stay away from funds that charge high fees unless they're getting you insane returns. And a lot of people don't know this. This is basic stuff. If you look at an investment prospectus for the first time ever and you see expense ratio, you don't really know what that means. But if I told you it's fees that you pay, you would understand. And if I told you that 1% isn't small, even though it sounds small, you'd really understand that that's something that you want to avoid. And so if you're looking in your 401k or your Roth IRA or something, and you see fees that are close to 1% or even higher, try to switch them out if you can, because that's going to eat away at your gains. Another reason ETFs are ideal for most people is time and effort. You don't need to be a stock picking genius or spend hours and hours every single week researching companies. I mentioned earlier the ETF SPY or even VOO, they're pretty much the same thing. They both track the top 500 companies in America. And so you don't need to do research on 500 companies. You can just trust that out of those 500, there's probably going to be a good amount of winners and they're going to win so much that it doesn't matter if the rest lose, you're still going to make gains over time. And this is a great way to spread out your risk and reduce it instead of just picking one single company that can fail. You have 500 companies and they're also the 500 biggest companies in the biggest economy in the whole world. So there's a pretty low chance that all 500 are going to go to zero. And so in my mind, I don't think there's a massive risk buying and holding S&P 500 ETFs. This approach also has the added benefit of being very easy to automate, which is my favorite part because nobody wants to manually go in and click investments and buying every single week or every time you get paid. It's way easier just to automate it and let that happen in the background, and then you can go on and live your life. So most brokerages allow automatic investing. For example, Fidelity, you can look for something called recurring investments, and that way you can connect it directly to your bank account and then set up recurring investments, say every 2 weeks when you get paid. And so when money comes into your bank account, Fidelity will automatically pull a small portion out, whichever you tell them to, and then it will also buy into the funds that you ask it to. And so you could set up something like $250 every time you get paid, buy the S&P 500, so you buy SPY, and then you become an investor all throughout the year, and you don't even need to think about it or spend time on it, but you know that you're building wealth. And the beauty about setting this up and having it run in the background is that you also get something called dollar cost averaging into the market. And that's basically a way to guarantee that you're never buying right at the top or right at the bottom of any single market, but your price averages out over time. And that's generally a really good and effective strategy for people who don't want to spend much time on this. This also protects you from making really bad decisions at the absolute worst time, which is when the market drops. When we have market corrections or, God forbid, a recession, you still buy. You're still buying as the stock market is going down, and so your price is getting cheaper and cheaper, which is good for you because we know it's more than likely going to go back up. Plus, legendary investor Howard Marks says the cardinal sin in investing is to sell at the bottom, and the last thing we want to do is upset Uncle Howard. So let's talk about some of the very specific benefits of using ETFs to build wealth. I already mentioned them earlier, but just to summarize them, number one is diversification, right? You're getting a bunch of different companies that you get to buy all at once, and so you're never stuck with risking your money in one single company. The second one is that you pay really low fees, like we saw, compared to something like a 1% fee that you might get in a mutual fund or a managed fund. ETFs are very cheap, and so they're not going to take much of your gains over time as you continue to invest in them. The third one is that it's very easy to automate. Again, find a brokerage that you can just connect your bank account to, and then buy every single time you get paid, or maybe every month whenever it's convenient for you. And then you get to buy in the market at regular intervals, and you get the advantage of dollar cost averaging, and you don't have to spend much time on it, which is kind of the last part too, which is benefit number 4. You get peace of mind, right? You can sleep well and rest well knowing that you're pretty diversified in the biggest economy in the world and the biggest companies within that economy. So as long as America is doing well, you're going to do well. Now, as far as potential risk and downfall with this strategy, of course, there's no perfect strategy, so here are a couple things to consider. Number 1 is market volatility. If you're somebody who checks your portfolio every single day, you're going to notice this very closely. Market chops up and down quite a bit, and it's very unpredictable in the short term. But as we know from history and from financial data, the market goes up and to the right over the long term. And so again, if you expand your time horizon out, you're probably going to be fine. I wouldn't worry too much about the market volatility. Risk number 2 is that you can overestimate your returns. I've been using 10% in the examples that we showed earlier because that's the long-term average return of the S&P 500, but that's not guaranteed, right? Just because something happened in the past doesn't mean it's going to happen in the future for sure. And the stock market has definitely had a few periods where there have been 0 returns over a decent amount of time. And you may have heard something called a lost decade. And that's when there's literally a 10-year period where the stock market starts at one point, it may go up, it may go down, and then it ends at one point over the course of 10 years, and you basically made no money over the course of a decade. That definitely happens. It's happened in the past. I'm sure it's going to happen in the future. But again, if you continue to dollar cost average, and if you don't need to retire right at the end of that period, I think you're going to be just fine. A third risk to consider is inflation. Now, people love to talk about inflation and macroeconomic trends, but I wouldn't worry about this too much. Stocks have historically beaten and outpaced inflation. Again, there's no guarantee that that's going to happen in the future, but you still want to be mindful of inflation, right? Because if your money just sits under your mattress, you're guaranteed to lose money because inflation is going to eat away at that. And what I mean is that inflation just makes things more expensive over time. And I bet you can figure this out if you ask your grandparents how much they bought their first house for. I guarantee it wasn't for $400,000. It was probably more like $20,000. And so inflation eats away at the value of your money over time if it's not growing with it or ideally beating it. And so I picture investing like a boat in the ocean. If the ocean and the rising tide is inflation, you want to be invested in that boat to rise with it and keep up with it at the bare minimum. And the last risk to consider is you. Staying consistent and not panicking during market downturns is one of the best things you can do as an investor, and it can also easily turn into being your worst enemy. If you freak out and you see that prices are dropping and you're scared that it's going to go to 0 and you're going to lose everything and you sell, again, that's the cardinal sin in investing. Most things are more cyclical than we realize, and that if it goes down, it's probably going to come back up. And also if it goes up, it's probably going to come back down at some point. And so don't freak out at either end. Just be aware that your own behavior can get in your way, which is why I recommend automating all this stuff so you don't have to worry about that. So why should you consider this approach at all? What's the bottom line of this whole thing? It's low cost, there's low fees, it is a time-tested strategy, and so you don't need to spend your time stock picking, you don't need to research companies, you don't need to read financial statements. You're taking advantage of a growing market, and if you stick to it over the long term, it's going to give you the highest chance to reach your financial goals. An ETF that tracks the S&P 500 like SPY or VOO, this is going to be your best bet to get the top 500 companies in America. So as long as you bet on America doing well in the long run, you're going to be just fine. This approach is also about financial freedom, not only in the sense of potentially reaching millionaire status, but also the mental freedom that comes with a simple, steady plan. And like I said before, if you want to be a stock picker, by all means go for it. I'm trying that with a small amount of my money in a different portfolio than my main long-term investing ones, but it takes a lot of research, a lot of time, a lot of reading. You need to read annual reports, you need to understand financial statements, you need to look into management of companies, you need to know everything about companies and their competitors and the market as a whole. And so it becomes pretty much a full-time hobby, right? It probably takes 10 to 20 hours a week if you want to do in-depth research on companies and pick stocks and do it effectively. And then you need to take time to learn all that. And so if you think that sounds exhausting or terrible and you'd rather just watch paint dry, just set up recurring investments into VOO every single paycheck, and then go focus on your families and your hobbies and anything else that you want to do. So to wrap it up, the good news is that achieving millionaire status is possible. The bad news is that it's going to take some time. You're going to have to be patient. But if you have a steady, disciplined plan, you can absolutely get there. Remember, this journey is about the long haul. It's about turning small, consistent habits into life-changing wealth. So take that first step and get started and let compounding do the rest, because becoming a millionaire is a lot closer than you think. So if you found this helpful, don't forget to hit like and subscribe for more videos that break down money and investing in ways that you can actually use. Let me know in the comments what's stopping you from starting your ETF investing journey. If you're still confused and want help with investing, I have some one-on-one financial coaching. You can find the link below in the description. I also have a newsletter that I write every single week to people about money and investing. It's called the Simple Wealth Newsletter, and it's absolutely free, so check that out in the description below as well. And that's it. We'll see you in the next one. Okay, that's when you make, dude.